morning. Welcome back to the Opportunistic Trader for a Monday afternoon, and I'm pleased to be with Adam Collins from Movement Capital, who comes on with us once minimally a week to talk about the commitment of trader data that comes out on Friday. And Adam is going to take us through the latest report and give us any pertinent information that is helping us with our trading. So I'd like to throw it to you, Adam. Welcome.
Yeah. Happy to be here. So let's get into it. First thing right off the bat is none of this is investment advice, so act accordingly. But so for any new listeners, if you're not familiar with the CoT report, what it is it's a report that's issued each Friday by the CFTC. Basically, they regulate commodity markets. It shows how different trader categories are long or short, different contracts. And the issue with it is when you have info, like if you're told, speculators are long 100,000 contracts of gold, or they're short, 90,000, you got this sort of like net figure in isolation. Doesn't really mean anything because you need to have context of if that current positioning is extreme or not relative to the past. And so my solution to sort of giving context to current positioning is just a 5-year percentile. So it's taking the current net number and it's sort of normalizing it on a scale of 100 to 0 over the past 5 years. And so for example, let's say if a trader category like speculators had a 5-year percentile of 100% in a contract, that would mean they haven't been that net long in 5 years, vice versa with 0%. So the way my website's organized is it's got, all of the per contract graphs. So for example, right here, this is for coffee futures, and there are two main trader categories. There are speculators and there are commercials, and commercials are producers and users. Producers are entities who, produce the commodity, and when they hedge, they're selling futures to lock in prices for their future production. And then users are people who use the commodity, and when they hedge, they buy. And so anyways, I've got, price up top, and then sort of the 5-year percentiles of the CoT metric at the bottom. So if it's at 100, it means that category is sort of, quite bullish relative to the past 5 years. And then the opposite is true for if it's like 0%. And so these are all like the individual, but the most like information dense part of the website, and honestly the main thing I'll look at are the dashboard graphs. So this shows you for all these different markets, you've got the contract codes at the bottom, sort of a snapshot of current positioning. And what you can interpret for this top graph that covers speculators in commodity markets is that it's probably not new news to a lot of people, but spec positioning in precious metals is historically very low. And in fact, it's most extreme in silver more than any others. And that's sort of a new development because for a couple weeks there, gold and platinum were sort of the standouts as having sort of these larger than other precious metals, net short positioning. But silver positioning really changed last week. And now it's with a 5-year percentile of 0%. What that means is that speculators haven't been this net short silver in 5 years. And so that's quite extreme positioning. But it's not just silver, it's platinum, gold, and then some soft commodities like sugar and coffee. And then so that's sort of, when you look at a graph like this and you're seeing lots of low numbers here, what that says in plain English is that, okay, specs in aggregate are leaning short commodities in a number of contracts. On the flip side of the graph on the left-hand side, where you can sort of identify contracts with, more so long exposure, you've got wheat, RBOB, heating oil, and crude. So you typically see those three in tandem. So that's sort of commodities. And then we've got financial specs. So this is same category, speculators, different grouping. This is financial futures, not commodities. And it's interesting in that spec positioning in financial futures is definitely less extreme than in commodities in that there's not as many, consensus short positions. In fact, there aren't really any crowded longs. But the two shorts that stand out, and I talked about them last week, are the Swiss franc against the USD and the New Zealand dollar against the USD. And so if we saw an environment of where, the USD started to bleed lower, positioning would lend itself to a quicker move, at least in my opinion, in those two currencies, simply because, everybody's on one side of the boat. And that sort of is a segue into here's how people screw up COT and positioning data in general is they hear sort of like a headline or like a little factoid that, like, a couple of weeks ago, everybody was talking about gold position, and that, is this big, this big crowded short in the gold market. Two things about that. First off, not true because it wasn't a crowded short. So there's a difference between sort of positioning being extreme and crowded positioning. And I'll give you an example with gold. So a couple weeks ago, speculators went net short gold for the first time in 12 years. That is interesting, definitely, but it's not synonymous with crowded short positioning. Over the past 12 years, gold spec positioning has leaned long. And in fact, most commodities are like that. But I don't know if that makes sense, but you can't sort of say, because speculators are net short, $1 to $2 billion worth of gold. That's not crowded short positioning. Crowded short positioning is if it was this monster, absolute level of net short positioning. It's not the case. It's just a situation of where gold specs were very long for a very long amount of time, and then they actually did flip to net short, which is interesting, but it's not a crowded short position. That was sort of a tangent, but what I was getting at with how people screw up interpreting positioning and COT info is this. So let's say somebody comes to you and says, okay, everybody's net long or net short this one contract, right? The average retail trader's like gut instinct is to hear that and to fade it because they think, I'm gonna go opposite the herd, right? No, that's not how you should treat that, because think about it. Last fall, WTI, a lot of people talked about how speculators were very long crude futures. I think the net positioning reached like 50 billion or something. But if you think about the environment, crude last fall was not a super, rocky trade on the long side. It was quite a steady uptrend. And if you were a trader or a fund manager and you were long crude, you weren't under a lot of pain for a long period of time. And so that sort of, in my mind, didn't present a catalyst for those crowded longs, those truly crowded longs, to pull long exposure. Where COT and position info gets actionable is if you get price action that puts traders under pain. So it's one thing if everybody's on one side of the boat, but they're all making money, all happy, the price action's going with them. And that's honestly not that uncommon, because sort of CTAs, they all tend to act like, a big herd. But it is more actionable and rarer to get a setup of where positioning truly is extreme, and then price action is going opposite of how those people were positioned. We saw a little bit a couple months ago in the euro, but I guess takeaway from what I just said is note current positioning, but pay more attention to it if price action hurts people. And obviously the takeaway for right now, like in commodities, is all these precious metals, they've been steady downtrends, every single one of them. And the second when they start to maintain a substantial bid, not pop 3%, but pop 10%, that's when you really get, a more actual situation of speculators being incentivized to revert to liquidate their positions. And so that was sort of a brief overview of COT, but I want to hit on some other stuff. So here's seasonality. Seasonality is just sort of the average price trend for a given contract at a point in the year. Similar to the other website, I've got sort of the per contract stuff here, but the main thing is the dashboard where I've got sort of the aggregation of, let's look at average monthly performance for different months of the year. And I've got September pulled up right here. So over the past 20 years, what has worked and what has not in the month of September. On the left-hand side, we can see long oats, long gold, long the 30-year have typically, had average positive monthly performance in September. On the flip side, we've had some contracts that have historically averaged negative monthly performance. It's honestly a lot of agriculturals like soybean meal, soybean oil, corn, soybeans. And then if you want to zoom forward to October a little bit, historically the top performers in October have been OJ, and honestly that's maybe this is an anecdotal viewpoint, but it's probably because of hurricane season spikes. But then we've got oats, soybeans, corn. So that's sort of a reversal. So a lot of these agricultural commodities that tend to weaken in September, historically it's sort of October's been a more positive month. And then October's been a negative month for the energy complex, heating oil, RBOB, and then crude over here, and especially cocoa. And then also like to pay attention to commodities, the term structure. So looking at, front month relative to the deferred months and seeing the degree of contango or backwardation. This isn't super important for intraday traders just because your time horizon is small. But if you're a swing trader, you're holding stuff for days, weeks, or months, term structure really matters because that's your cost of holding the position. So for example, if you came to me and said, hey, I've got a long thesis on wheat, I want to go long front month wheat. When you've got contango of 4% between the front and second month contract, that's going to cost you to keep that position because you're going to have to roll it to maintain it. And I know it doesn't sound like a lot, but 4% over a couple months, that'll bleed you dry quite quick. When you look at, I also like to look at momentum. This is sort of a proxy for CTA positioning in commodities. So CTAs, on average, they're trend followers. When you've got 12-month momentum that's positive, you can infer that long-term trend followers are biased to the long side, vice versa for the short side. And so it's sort of balanced. Earlier this year, this graph was way more dominated with, bars that were highlighted green because, in January, a lot more commodities were sort of positive over the last year. So the top performing contract over the past 12 months has been front month WTI, followed by heating oil, cocoa, wheat, ES, and then the worst performers have been some of the agriculturals and the precious metals too. And then another new thing I wanted to hit on this week that's sort of, new for any of the people that have watched this is I do maintain another website and all these are free, but this website is solely centered on the S&P. And this is centered on the S&P. It's obviously vastly different than how Larry trades, which is, more short-term technical. This is more longer term and then looking at sort of different data points, be it technical, sentiment, rates, or macro. So here's a crash course through current technicals of the S&P. And remember, this is from probably a swing trader's perspective, not intraday. So momentum is still positive. And by the way, how these graphs are oriented is for each metric, momentum, there's sort of a cutoff. Think of it as like a green light, red light. Green means go, long, red, out. So with this momentum, this basically says, hey, if the S&P's up over the past 12 months, momentum is positive, be long. If it's negative, be out. You can see how historically, over the past 25 years, worked quite well. So momentum's still positive. That's a positive in my mind. Trend is a very similar metric, but it's just looking at the price relative to like a 200-day moving average, and we're obviously well above the 200-day. Here's a non-price technical, which is seasonality, sort of similar to the other thing. Yeah, so people sort of laugh at the best 6 months thing of like sell in May, go away. It's worked though, which is interesting to me, and it hasn't just worked in the U.S. It's worked in the UK stock market for a long time. There's a paper right here. Anyways, what this metric says is, hey, if your time window is between April 30 and November 1, historically that's been the worst 6 months of the year for the S&P, be out. That's the orange line. Blue line is if you're in between November 1 and April 30, be in. And so you can see that over time, sort of the best 6 months of the year has massively outperformed the other six. And we're currently in the orange line, the other six, just because it's not November 1 yet. Then this is sort of an interesting thing. It always blows people's mind, in my opinion, when they sort of understand this one. So this is what's called the FOMC drift. And it's the tendency of the S&P to drift higher approaching FOMC announcements, and defined as the 20 trading days before FOMC announcement. And so that's what the blue line is. It's only being long S&P in that little window. The orange line are the other trading days. And it's just like this massive magnitude of outperformance if you're only long the S&P in that sort of pre-FOMC period. And then we got another sort of technical indicator, which is buyback activity. So most companies in the 5 weeks leading up to their earnings announcement suspend buyback purchases. It's sort of called the blackout period. Now, obviously that period is unique for each company, but there's sort of like this, grouping behavior of earnings announcements. Like they sort of like condense in a certain time window. And so what this indicator does is say, hey, when are the majority of S&P reporting companies going to be in that blackout period, right? And what this indicator says is only be long S&P when we're outside of the blackout period. That's what the blue line is. The orange line is only being long S&P in the blackout period. And you can see that there's a big sort of delta in the performance between the two. And you might look at this graph and say, hey, Adam, why is there such a big gap between, the size difference between the orange line, the blue line, and the white line? And the white line is buy and hold. It's because the graph is linear. It's not logarithmic. If it was a log chart, it would be like an equal distance. Another technical indicator, I like to look at margin debt. Margin debt is one of those indicators that people, I think, interpret wrongly. So they throw up, a scary graph of how margin debt is this big nominal figure. Like, margin debt's, $600 billion, right? Okay, so just as I don't think you should judge an economy based on like the nominal size of its GDP, you should look at like the rate of change. And so what I care about with margin debt is expanding or is it contracting? So when it's expanding, historically, that's actually been good for the S&P. So sort of the filter is if margin debt is positive over the past year, be long. If it hasn't, which is where the red line is right here, be out. And so historically, it's worked to pull S&P exposure when margin debt has been growing year over year. And right now, margin debt has grown like 10% over the past year. You can see that right here. I'll quickly go through the rest. So a quick gauge of sentiment. So this is the AAI survey. It's like a retail survey. It looks at the spread between percent bulls and percent bears. We're sort of in the middle. It's not at extremes. So retail sentiment to me is not either very optimistic or very complacent. This is looking at the percent change. So the biggest sort of ETF in the world is SPY. And this is looking at the percent change in shares outstanding. Think about this. So if you've got a big amount of creation activity in this ETF, you're going to have a lot more shares created, right? And so that says to me, okay, big interest in going long S&P. Vice versa, if there's a big reduction in shares outstanding, that says to me people are scared. And so all that to say, not a big difference in sort of activity right now. And then we've got another sentiment survey name. So this is more institutional oriented, like active investment managers. And this is definitely leaning more optimistic and bullish than retail. So names where they poll people of like, hey, super bullish, super bearish, et cetera. And right now, on average, a lot of name respondents are responding quite bullish. But you should hear that with the caveat of, I personally think, and it's just a personal opinion, I think that sentiment is one of those things of where it's never enough to take down a market. Like you have to have other things. You've got to either have deteriorating technicals, a weakening macro picture, crazy stuff going on with interest rates. Sentiment by itself, I don't think will ever represent like a brick wall to like equity prices. And so, active investment managers are definitely leaning bullish, but take it with a grain of salt. This is looking at the CBOE's put call ratio. And so if this is super high, this says people are buying a lot of puts relative to calls, therefore people are fearful. You can see the indicator, like basically if it's low, if it's in the red, that means that not a lot of puts are being bought relative to calls, which indicates complacency and sort of like optimism. We're in the middle. You can see the extreme, like fall 2015, tons of put buying, tons of fear. And then that was sort of a near bottom in equity prices. We can move to this one. This is looking at the VIX futures curve. So the percent difference between front month, second month. Lots of contango typically equals complacency. Lots of backwardation typically equals fear. The VIX future curve sort of flattened out a little bit last week, but we still stayed in contango. This is looking at interest rates. And this is this chart, I think some people would find interesting because we've all read about how, the very scary potential curve flattening in the US. And the interesting thing about that is if you genuinely care about yield curve implications for the S&P, you should not care, in my opinion, about curve flattening. You should care about curve steepening. Because historically, what this chart is showing, this graph, the plot in the middle, is showing the 12-month change in the 10-year minus 2-year spread. So when it's up here, what this means is that the curve is rapidly steepening, which means that more often than not, it's meant that short-term rates have like quickly come down and long-term rates have either gone up, stay the same. But then down here, like an extreme, like right here in 05, this says we've had really rapid flattening. So, and typically that means short-term rates have come up, against long-term. And so what this chart is is that basically when the yield curve has significantly steepened, that's been really bad for the S&P. And it's opposite to the common narrative, which is, a yield curve flattening is very ominous. The people who say that, they do have a point in that, most of the times the yield curve has sort of preceded a recession. But what's tricky about that statement is that who knows about the lead lag time? It might flatten 6 months before, it might flatten 3 years before. And so to me, that's of limited use. Here's another sort of interest rate indicator. This is looking at high yield spreads. So for high yield bonds, it's sort of the yield spread over risk-free treasuries. And what I care about is if those spreads are widening out, and they're not right now, they're pretty flat. They're like 350 basis points. This is a TED spread. So a lot of people earlier this year were looking at that LIBOR OIS spread, which is related to this TED spread. And the reason why they're looking at it, because it's sort of an indicator of stress in the banking system. And it was blowing out earlier this year, but it's come back, it's given all of it back and more. So, what the TED spread is the spread between 3-month LIBOR, 3-month treasuries. And in plain English, when that spread decreases, sort of the spread between, unsecured LIBOR and risk-free treasury is lower, which says to me, less stress in the banking system. Final page on this is the macro indicators I care about. So I think in an earlier webinar, I talked about caring a lot about our probability of going into a recession. This is partially where I derived that. So all these indicators are macroeconomic indicators. They're all US centric. And rather than sort of optimizing, what level sort of indicate a recession or not in the past, I don't do that. I just look at, hey, are they positive or negative year over year? So industrial production, that's sort of a business activity indicator. It's definitely positive year over year. It's up, 4.2%. We've got retail sales, which is sort of more of a consumer indicator, because 70% of U.S. GDP is people spending money. And so that's synonymous with retail sales, and retail sales have actually been accelerating, which is, quite strange to see. I don't know if I would use the term late cycle, but I think that's probably confused some people, seeing retail sales start to accelerate, which indicates a strengthening U.S. consumer. We've got the unemployment rate. So with the unemployment rate, I don't care about its absolute level, high, low, who cares? What I do care about is if it's rising or falling. So think about the implications of this. If you've got an unemployment rate that is rising chronically, that means that you've got more people unemployed, less people making money, less people spending money, weakening the economy. And so it's an indicator of, the labor force. And so right now, the unemployment rate is low and still trending lower, which is, insane. It's been trending lower for 7-8 years now. PMI numbers. So this is, business activity. It's strong. I think that last PMI print was 61, which is extremely high. And so this paired together with that industrial production from earlier points to a strong U.S. Business environment. Housing prices, on average, U.S. housing prices have gone up 6% over the past year, which is really strange because, well, it's not super strange, but so U.S. housing prices have risen at this same clip for 3 years. You can see the history of this data series. It's sort of boom bust. It's sort of it rips, it contracts. And so U.S. housing prices have been quite steady over the past couple of years. This is looking at EPS, and it's distorted by the strange 2009 data. But basically, U.S. EPS is for the S&P is up 15% year over year. And sort of as all my sites have a dashboard, here's the dashboard for this. And all it is for all those categories: technicals, sentiment, rates, macro. It just gives each indicator a 1 or a 0. If it's above or below, it's filter. Basically, if it's a 1, green light, go. If it's a 0, red light, don't be long. And on average, most of these indicators are healthy. So I know that was a bit of a information overload, but if anybody's got any questions, I'm happy to answer them.
I appreciate it, Adam. It's Larry, and I actually have a lot of questions. I'm enamored.
Well, go ahead.
I'm enamored with what you're doing here. I think it's awesome. I think it's really, really important. And I look back over the years, and really, that was a lot of my mantra, was sort of figuring out positions, thinking or seeing by flow and by pricing, on options mostly what the positions were, and we were able to go through that and have a little bit of an advantage. So, it worked for me for a really, really long time. It still works, but it's definitely more granular in the amount of work that you're doing here, which is impressive. And I've been watching it over the last bunch of months, and it really helps out. But a question that I had is, how do you, when they're putting out the this data on Friday, how do they account for options? Is options in
good
this?
question. Yeah. So that's a good question, because there's two varieties of the CoT report. There's futures only, then there's futures plus options. And a lot of people still use the futures only report. And I think it's silly, because you got to reflect position in the options market. And the way they do it is they just convert it on a delta equivalent basis. And so if you get an option with a 10 delta, that'll be equivalent to 1/10 of a futures position in a contract. And so, yeah, this includes options, and it's converted, like for like with delta.
Okay. And then my question to you, are there different markets that you look at to give you sort of different signals? So like a big spec long, or I remember we were speaking, I don't remember what it was, a bunch of months ago when 10-year bond yields were above 3% for that quick minute, and you came out and basically said it was the biggest short position basically that you've ever seen, or one of. That was a pretty big, as you would say, green light that it was probably a short, and it worked like a charm. But did markets act differently? Like for example, S&P, there's so many different ways to go around in the S&P to be long. You can buy equities, you can buy options, you could buy, ETF. You could do it in so many different ways. So in a way, to me, in the S&P, it's hard to get that signal, I think, or harder than it would be in a commodity market, even ex oil, ags and whatnot. So I was wondering, what your thoughts are on something like that, and how you play it.
Yeah, for sure. So, I basically, when it comes to these different markets, CoT matters the most, in my opinion, 100% for commodities, for one simple reason. Commodity futures are the primary market for commodities. With currencies and stocks, think about it. If you're looking at CoT positioning on currencies, you're just looking at listed future positioning. You're not even looking at spot FX stuff. Same with stocks. You're ignoring ETFs. You're ignoring cash equities. And so that's not to say that CoT, that positioning info in equity futures isn't important. It is, but it's a small part of the pond. It's not the whole pond. And so and to the nth degree, I really do not pay attention to bond positioning, because with bonds, as you know, you can frequently spread contracts against each other, and also bond futures are not the primary bond market. So yes, with CoT, I think it carries more weight in the primary market of commodities. And then that being said, you can even get more detailed and say, okay, between all these commodities, where does it matter most? And here's what I would say to that. In these commodity markets, basically the composition of the markets changes by contract. So for example, in some of these sort of more illiquid soft commodities, like literally orange juice, speculators aren't a big player in that market. It's more commercial driven. And so if you're gonna look at positioning, maybe look at the big fish relative to the small fish. And when I define big fish and small fish, I'm talking about how much of the open interest they control. But the opposite is true in some spec-driven markets like WTI, and natural gas too is actually really a big percentage of the nat gas open interest in Henry Hub is driven by speculators and not commercials. And so I guess to answer your question, yes, for CoT, I like to use it the most in commodities, because it's the purest view of positioning within that asset class. It's a little more diluted in financial futures. And then within commodities, you sort of got to exercise some nuance between contracts that are controlled by speculators and contracts that are controlled by commercials.
For sure. I've traded a lot of nat gas in my day, not as much now as I used to when it was going crazy about 10 years ago. But,
Yeah.
that would seem like it would work there because, to me, looking at this stuff is you got to look at where you're going to get your bang for your buck. So, like, it was interesting when you mentioned, silver positions, net
Yep.
short positions on spec were very, very large. I mean, there's no really offset to trading silver. I mean, you might want to buy a couple of
Right.
silver stocks, but that's not market moving. There's no
Right.
ETF or equities that would replace silver. So to me, that would be a pure thing to look at and be
Right.
maybe fading that trade. It's interesting though. It seems like the metals, as you said, like in gold, they trend for real. I mean, obviously, they counter trend sometimes inside the trend, but they trend for a long time. So the
Yeah.
longs were long for, like you said, 10 years, but now, we have to see, and it'll be interesting, to see how it plays out. I just wanted to sort of get your feeling on what markets were better to look at, like S&P. It's too, for me, it would be too hard to determine unless something really flashed, red or something with the put call or anything like that, that would be more of a signal than the pure commodity.
Yeah, here's one point that I think is like drastically underappreciated by people who invest and trade in commodities. So if you zoom back like 20, 30 years ago, these commodity markets, they were dominated by commercials. Like it wasn't, I mean, there were a couple of CTAs out there, but they didn't control a lot of the open interest. And in fact, I've got a graph somewhere. It shows that like in the 80s and 90s, I think specs controlled like 5 to 10% of the open interest. And now that number is 50%. And you might ask, okay, Adam, like, why does that matter? So that more traders are controlling, these commodity markets, but why does it matter? Here's why. So we all know and see these like monster track records for CTAs in the 70s, 80s, and 90s, right? Like these are absurd rates of return. And you have to ask yourself, why did that exist? Like, and over the past 10 years, everybody knows CTAs and trend followers have not, it's been a tough decade for them. And you might ask, like, why is that? So let's think about this. So let's go back to 1980 and let's look at a market like corn or any commodity. Okay, so when these markets are dominated by commercials, that's honestly the same thing as saying these markets are dominated by commercial producers, not commercial users. You might say, wow, it's because when you're a user, you've got a little bit of wiggle room of you being able to sort of pass, price increases off to the end user. But if you're a commercial producer, like if you're a corn farmer, you probably are having a lot of leverage, and that you're going to be grossly unprofitable below a certain price per bushel. So you've got a big incentive to hedge, right? The takeaway from what I just said is that commercial producers tend to dominate the hedging side relative to commercial users. So when commercial producers hedge, what do? They sell. So when they sell, they're selling 6 months out, 12 months out. And when you've got tons of commercial selling, that depresses a futures curve. So it pushes it into backwardation, right? Now, in these commodity markets, who takes the other side of the trade from commercials? Speculators. So in the 80s, 70s, 80s, 90s, when these markets were controlled by commercial producers selling, there weren't a ton of speculators to sort of accept that price risk, right? So they got paid. And remember, if a curve is in backwardation, that means sort of the front month's price is higher than the back month, right? And over time, a curve in backwardation, you can sort of assume that back month, think of it as a roll yield. You sort of capture this positive carry over time when you're long the deferred contracts. And so it's sort of like the commercial hedgers were paying this insurance premium to a very small amount of speculators that were sort of the offsetting longs of their shorts. But what happened in the early 2000s? We had a ton more speculative interest in commodities. And what do speculators do with commodities? On average, they buy them. So they want to get, long commodity exposure. And so you had all these speculators that threw money into commodity funds, commodity futures in the mid 2000s. When you go long commodities, you buy. And when you buy, basically you're forcing up the price of these deferred contracts. What it meant is that all these commodity curves went from being sort of like super depressed in backwardation from producer selling to speculators came in and sort of absorbed more of that insurance premium. And I guess the analogy is, think about this. If there's one company offering flood insurance, on the Gulf Coast of the US, and they're the only company doing that, it's gonna be highway robbery. They're gonna be able to command, a big premium for their services relative to the payouts. But if tons of, more insurance companies come along, you're going to see sort of insurance spreads flatten out. And that's what speculators did to these commodity markets. They came in and they sort of forced up these curves, and there's less of a roll yield for them to earn, which is why I think is a big reason why CTAs haven't done much over the past decade. It's just because there's so many of them. And I know that was probably a long tangent, but
but I like the thought process, and I think about it a lot because players like John Henry and Soros and all these guys, there were a handful of players. So you had the actual producers versus the specs, and the specs were large, at that point maybe billion-dollar hedge funds, not the way they are now, but right now, off the top of your head, you could probably think of 50 funds that have $10 billion, in the marketplace. So that's why there's no room to run. They were looking to make 25, 30, 40%, and they were able to do that per year. Now, people are just looking to make, any type of return with rates at these low levels. So I think you're exactly right. There are too many players in the space and too many positions going the same way. And in the commodity space and the CTA space, it's hard to get those trends that they used to have.
Yeah, I mean, what's interesting too is a couple weeks ago, so one of the biggest CTAs in the world is that firm in the UK called Winton. And the David Harding guy, he wrote an article, and he basically said trend following doesn't work as well as it used to. It's a more crowded space, and we're sort of diversifying our firm away from being just a one-stop trend following shop. And it was interesting to me because the gut response of, I don't care, it's not just CTAs, but anybody, when sort of their strategy doesn't work, they sort of instinctually craft sort of rationale for why it should work in the future, right? And maybe there is merit to that, absolutely. But it's sort of unique to see somebody sort of look in the mirror and say, you know what I was doing isn't working as well, and I'm adapting. And that's what sort of Winton came out with. It's a very interesting article. But
so
anyway,
what do you think that means? You think he's going to short his duration?
No. So yeah, he basically had the answer in the article. They run a lot of different strategies, some not just trend following. And in the article, he was basically saying, hey, we're sort of pivoting our strategy basket away from trend following to just other stuff, literally anything other. And so yeah. And so that was a takeaway of that.
That's interesting. I kind of think that falls more into the mantra of what I do. A little bit of mean reversion,
right,
staying inside the trend, just trading a lot more and taking profits. You can't get the profits you used to get on these trades because they don't work as well,
Yeah, it's a thing of like the age old. So CTAs and managed futures, where they raised all their money was like 2008, 2009, because people looked at the track record and said, oh my God, they didn't lose any money in the great crisis. Here's all my money. And I think it's one of the most like bulletproof relationships in trading, which is after something has recently crushed it, money comes in and then it does not crush it. And it's not just
for sure. But also what I've found, because I've managed money for a long, long time, in the CTA space, they give you a ton of room. I ran a global macro fund. If we lost a couple of percent, people would be freaking out. These guys, like I hear the numbers from Mike, who's much more in touch with that space, who works with me, and he's like, oh, they're down 14, they're down 12. I mean, it's unbelievable. So, I see a big difference, in the CTA space. It's, it's feast or famine, and it's been a famine for a while, I guess. So, it's just interesting that the risk tolerance, for that space is more than any other space out there.
Well, do you think that's a function of, now I'm completely outside of my domain and talking about this stuff, but as the hedge fund industry has evolved, it seemed like it's lower risk tolerance is a function of its average dollar being more institutional than individual. And well, first off, I'm going to ask, do you think that's a fair assessment of sort of the hedge fund space?
Yeah, I do. I think people are just looking for a return anywhere. But again, that goes to the mantra here where these CTAs are swinging 10% a month, so there's
Well, what I'm saying is, do you think that's because the average CTA, do you think you've got less institutions, more individuals in CTAs that sort of gives them that leeway of extra volatility? Or do you think they just had a longer leash?
I think they give them a longer leash. There may be more individual investors in that space. I don't think so, but I'm not sure. But I think it's just in general, it's a way for them to be able to hang on to positions. They're more, they're more trend followers than traders. So I think that space. Obviously, there's all different, categories inside that space, but in general, that space is trend following for the most part that I see. Now it's mostly systematic trend following. So it's just interesting, because the space of commodities in general, because they do move a lot more, they have to give a little bit more leeway. So just interesting.
Well, I think what's hurt them recently is, so as the AUM and sort of the CTAs and managed futures has ballooned, they've had to sort of stray from their original mandate, which is, for a lot of these original managed futures programs, they're quite diversified. Different. You got some metals exposure, financial exposure, rates, et cetera. But if you get a ton of money and you're a managed futures fund, you can't put a lot of that money to work in a lot of these smaller commodity markets. You've got to be more financial futures oriented, be it currencies or equities or bonds, whatever. But the issue is, this over the past year, we have had some stellar trends in individual commodities, be it cocoa, lumber, I guess precious metals on the short side. And what I'm getting at is this year has been sort of a year of underperformance by trend followers, and it's a shame because their money sort of been forced by design into these more liquid financial contracts when the truly great trends haven't been there. They've been outside of there in the smaller markets that they can't really tap anymore. But anyways,
yeah, I think you're right. Listen, I'll tell you what, we're 6 months into the year, and I'll tell you that, I was long gold at the beginning of the year, towards the end of last year at 1320, 1300, and we were able to make money on it. Thank God we got away from it. But, that thing was held in for a really long time, and then it just debacled, so.
Yeah.
And then, what I find as well, that lower prices bring sellers. So same thing will happen in S&P when we do correct in some century far from now. But when we do, when we do correct, you'll find sellers at lower prices.
I've been amazed to see the divergence between international equity weakness and the S&P. Just like nothing can take down the S&P.
I got to tell you, I talk about it every morning on our morning call, and I come in and I say China's down 2% and the S&P is positive. Europe is flat and the S&P is up 0.5%. Europe's down 1.5% and the S&P is down 30 basis points. So that mantra has been working. Something's probably going to give at some point, but maybe they ride that trend to the end of the year. I don't know.
In your opinion, what's the highest probability catalyst for that sort of relationship breaking down?
People outside the U.S. believing they're a lot stronger than the market believes. So when I say that, I mean, Trump is, and I don't ever like to talk politics, which I won't, but, Trump with the tariffs, is hitting everybody. Now he went after Japan last week. Eventually, these guys are going to probably turn around and go, this guy's not real. He can't do what he's saying he's going to do. I saw it a little bit in China. The other night, I think it was Thursday night, we were waiting for them to implement the $200 billion, the first $200 billion. They shied away from it. And then on Friday on the plane in the middle of the day, he goes, we're going to put another 260. Well, you know what? You didn't put the first 200. And if you put $500 billion, that's almost the whole picture. So
Yeah.
again, I don't know. So when you ask what it'll be that people wake up and realize maybe he's not as powerful or as real as he thinks, and then I think that trade comes off. So, but again, we're not close to that yet, obviously.
Yeah. It's, what's been interesting to me is of seeing China's degree of retaliation with the tariff stuff, because so on one hand, you could make the argument that sort of like it was a game theory thing of like they're not going to let Trump sort of like knock him around, so it's going to be sort of like this aggressive response thing. On the other hand, if you think about this, so like this is also very outside my domain. I just like to think about it, but so China never really had a recession in 2008. They sort of met that crisis with massive credit creation and sort of stopped it in its tracks. And they also responded that way in 2015, 2016. And so China as an economy, I don't say something like the quote unquote they need to have a recession, but like there's obviously the economy has sort of been like this well managed slowdown. And if I was their leader, Trump would give me this perfect scapegoat for sort of letting my economy experience weakness, such as, the writer Taleb, he writes about how, people who control forest fires, they light small fires to be able to, have the forest be more robust and resilient to actual forest fires. If I was leading China, I want to experience a little bit of weakness. I want to clear out some of the non-performing loans, some of the crap, so that it's a more robust economy going forward. And if I was looking at Trump and I was seeing him going off and saying all this stuff, I would just let him run with it, let my economy experience a little pain related to trade or whatever. And then if people look to me and say, why is this happening? He can point to Trump and say, well, this guy's, going off the ledge and, is a complete, whatever. And so all that to say is I'll be really interested to see Trump's obviously of the mindset of escalation, right? It's only everything sort of led that way to him. And what's most interesting to me is if China sort of accepts it or if they sort of stand up and say, nah, we're going to make this difficult. So who knows? I have no idea.
Yeah, no, it's an interesting point, and it gives them a little bit of a way out. I don't think they're going that route with the way they're protecting the yuan, and they're manipulating. So I don't think they want part of that. I think they're gearing up, but I do think at some point this whole thing is going to backfire on us in some way, and it's backfiring. People just don't feel it right now, but prices on everything are going to go up. And you saw that a little bit in the, the wage inflation number off of unemployment. So even though the market was scared of that for about 2 minutes, it's, it's an interesting thought and something to keep an eye on. For sure.
Here's the thing, and I know we got to wrap it up because we run long, but here's the thing that probably scares me most is that when you see these like global fund manager surveys of like the average fund manager perception of like if U.S. equities are overvalued or cheap or whatever, that the consensus is very clear. Everybody's on the same page that the U.S. stock market is richly valued, right? But what's crazy to me is that they both acknowledge that, and then on the same sort of token, they say, oh, but we're overweight U.S. And so when you sort of pair those two statements together, you're implicitly saying, I know this thing is crazily overvalued, but I also think I'll be able to get out of it before everybody else does. And so it's like this confidence game of if S&P starts dripping lower 5-10%, I think it can only cascade because I don't know. It's just a thing of where when your investment thesis is behavioral and you basically acknowledge that we're overvalued, you're going to be so sensitive to a 10% drawdown that I think I don't know. We sort of saw it in early February of where, I don't know, there's back-to-back vol, and it resolved itself. But who knows?
Somehow.
Who knows? Yeah.
No, I love the point, and I look at that every day. But the defense of that, unfortunately, is that by buying the U.S., you're really buying the U.S. dollar, and the dollar's been performing very well. So they get the double whammy. So if you're in euros and you're buying U.S. markets, you're getting long the U.S. dollar as well as equities. So I think a lot of that is that, and it'll be interesting to see how it plays out. But I will say, in my time at doing this, I've never seen divergences like this. And then the kicker is the volatility index being, listen, it's not high at 15, or right now I see 1480. It's not high, but the last time we were at these highs, it was at 9 or 910, in January. So those are things to look at. And then the volatility skew out a couple of months is bid. So maybe it's seasonality, maybe it's the election. It'll be interesting to see how everything, plays itself out here. And, I think what you're doing is, first of all, it's unbelievable. It's extremely impressive to me, the amount of work and amount of information for the trading community that you're providing. And, I look at it all the time, and it really helps me out, and I appreciate it.
Well, yeah. No, I definitely appreciate everything at the Opportunistic Trader. And if anybody who listened to this and they got questions about it, just email me. I'm happy to help out.
Well, I appreciate it. So we'll call it a wrap, and on a quiet Monday. And Adam, I appreciate it as always. So we'll catch up later in the week or early next week.
Will do. Thanks so much.
All right.
Bye.
Have a great day. Bye-bye.